Before we begin, a quick and important disclaimer. The information provided in this video is for educational and entertainment purposes only and does not constitute legal, financial, or tax advice. Divorce law and retirement account regulations are complex and vary significantly by state jurisdiction. You should not act upon this information without consulting with a qualified attorney or financial professional who is familiar with your specific circumstances. All discussions regarding historical trends and case studies are intended to illustrate concepts rather than predict future results. Please conduct your own due diligence before making any decisions regarding your marital assets or retirement planning. Imagine working for 35 years, diligently contributing to your 401k, passing up vacations and luxury purchases to ensure a stable future, only to watch 50% of that nest egg vanish in a single courtroom session. In the United States, a 401k is often the largest or second largest asset a couple owns, frequently surpassing the equity in the family home. Yet, most people treat it as an afterthought until the papers are served. There is a silent epidemic of retirement poverty, affecting divorcees who didn't understand the technical mechanics of a QDRO or the tax implications of asset division. Today, we are opening a deep dive retrospective on the evolution of 401k divorce in America. We are going to look at the massive shifts in how the law treats your retirement, the hidden math that destroys portfolios, and the historical precedents that have shaped the current landscape of domestic relations orders. By the end of this masterclass series, you will understand the structural anatomy of retirement division better than many general practice attorneys. We are solving the problem of financial ambiguity, giving you a clear-eyed view of how the system actually operates when a marriage dissolves in the 21st century. To understand where we are, we have to look back at the historical shift from defined benefit plans to defined contribution plans. In the mid-20th century, the pension was king. If a couple divorced, the pension was often viewed as a future stream of income that was difficult to value and even harder to divide. However, with the introduction of the Revenue Act of 1978 and the subsequent explosion of the 401k, the wealth of the American middle class shifted from a guaranteed monthly check to a fluctuating individual account balance. This changed the stakes of divorce entirely. Suddenly, there was a specific liquid-adjacent number sitting in an account, and both parties had a legal claim to it. In the United States, the division of a 401k is governed by both state domestic relations laws and federal law, specifically the Employee Retirement Income Security Act of 1974, known as ERISA. This creates a complex overlap. While your state court might decide that your spouse is entitled to half of your retirement, the plan administrator of your 401k cannot simply cut a check based on a standard divorce decree. This is where the Qualified Domestic Relations Order, or QDRO, comes into play. Without this specific legal instrument, attempting to move funds from one spouse to another can trigger massive tax penalties and immediate 10% early withdrawal fees if you are under the age of 59 and a half. Let's look at a case study to illustrate the gravity of this process. Consider a hypothetical couple in a community property state like California or a marathon equitable distribution state like New York. If the husband has accumulated $500,000 in a 401k over a 20-year marriage, the law generally views the contributions made during those years as marital property. If the divorce occurs and the court orders an equal split, the QDRO process must be initiated. If the couple attempts to bypass the QDRO and the husband simply withdraws $250,000 to pay the wife, the IRS views this as a taxable distribution. The husband would likely owe federal and state income taxes on that $250,000, plus a $25,000 early withdrawal penalty. By the time the dust settles, that $250,000 payment might only net the wife $150,000, while the husband is left with a massive tax bill. The QDRO, however, allows for a tax-free transfer of those funds into the recipient spouse's own IRA or retirement account, preserving the full value of the asset. Understanding the coverture fraction is the next layer of this deep dive. This is the mathematical formula used to determine what portion of a 401k is actually marital property versus separate property. If you started your 401k 5 years before you got married, those first 5 years of contributions and the growth associated with them are typically considered separate property. The marital portion is calculated by taking the number of months the party was a participant in the plan during the marriage and dividing it by the total number of months the party has been a participant in the plan. This fraction is then applied to the total account balance. However, many people fail to account for the passive appreciation of the premarital portion. If the $50,000 you had before the wedding grew to $100,000 purely through market performance during the marriage, is that $50,000 gain marital or separate? Different states have different historical trends in how they answer that question, and the data shows that failing to trace these assets accurately can cost a participant tens of thousands of dollars. Furthermore, we must address the valuation date trap. In a volatile market, the date the court chooses to value the 401k can change the outcome by 6 figures. If the valuation date is the day the divorce is filed, but the actual transfer of funds doesn't happen for 12 months, a market crash or a market surge during that interval creates a massive discrepancy. Some jurisdictions use the date of separation, some use the date of the trial, and some use the date of the actual distribution. Historical case studies show that in the 2008 financial crisis, many spouses who were awarded a specific dollar amount rather than a percentage of the account found themselves in a position where the 401k no longer held enough value to satisfy the judgment, leading to years of secondary litigation. Another critical element often overlooked is the distinction between pre-tax 401k contributions and Roth 401k contributions. Dividing these as if they are equal is a fundamental mathematical error. A $100,000 balance in a traditional 401k is not worth the same as a $100,000 balance in a Roth 401k because the traditional 401k carries a latent tax liability. When you eventually withdraw that money, you will owe taxes on it. The Roth money is yours clear and free. In a high-stakes divorce, failing to tax-adjust these assets means one spouse is walking away with significantly more purchasing power than the other, even if the balances on paper look identical. As we move through this retrospective, we will examine how the Majoska's formula and other landmark legal precedents have shaped the way modern judges view these accounts. We will look at the administrative nightmare of missing participants and what happens when a company merges or goes bankrupt during a pending divorce. We are also going to dissect the impact of 401k loans. If one spouse took a loan against the 401k to pay for a kitchen remodel, that debt must be accounted for in the division. Does the spouse who stays in the house keep the debt, or is it deducted from the total marital pot? This isn't just about spreadsheets. It's about the long-term survival of your financial independence. The data suggests that women, in particular, see a statistically significant drop in their standard of living post-divorce, often because they trade the long-term security of retirement assets for the immediate, but high-maintenance, asset of the family home. We are going to analyze why keeping the house is often a strategic error compared to keeping the 401k. By investigating the last 40 years of American retirement law, we are providing you with the context needed to navigate a system that is often counterintuitive. We are going to break down the specific language required in a QDRO to ensure you aren't hit with unexpected fees from the plan administrator, which can range from $500 to $3,000 just for the privilege of processing the paperwork. This is part 1 of our 10-part masterclass. We have only scratched the surface of the history and the basic mechanics. Ahead, we will dive into the specific state-by-state variations, the role of forensic accountants in tracing hidden contributions, and the future of retirement division in an era of gig economy, 401ks, and decentralized finance. Prepare yourself because the math of divorce is far more complicated than simple subtraction. To truly grasp the gravity of 401k division in 2026, we have to examine the concept of the marital pot through the lens of tracing and commingling. Most people assume that if they owned an account before marriage, it is safely theirs. However, the reality in U.S. courts is often far more nuanced. Consider the story of a software engineer named Michael who lived in Austin, Texas. In 2014, long before his marriage, Michael had $100,000 in a 401k from a previous employer. He got married in 2016 and, over the next decade, continued to contribute to that same plan while the market climbed. By the time he and his spouse, Sarah, decided to part ways in early 2026, that account had grown to $650,000. Michael assumed his original $100,000 was separate property, but during the discovery phase of the divorce, it became clear that because he had rolled over that old 401k into a new employer plan during the marriage and continued to add marital funds to it, he had commingled the assets. In many jurisdictions, once separate and marital funds are mixed in a way that they cannot be easily distinguished, the court may lean toward classifying the entire account as marital property. Michael's failure to maintain a separate, frozen account for his premarital assets meant he was now fighting an uphill battle to prove exactly how much of that $650,000 was attributable to his initial investment and its specific growth, versus the contributions made during the marriage. This leads us to the critical role of forensic accounting in modern 401k retrospectives. Accountants use what is known as the subtraction method or the tracing method to try and reconstruct the history of an account. They look at every statement, every contribution, and every market fluctuation over 10 or 20 years. If Michael had lost his statements from 2016 or 2017, the court might have simply defaulted to the assumption that the growth was marital. This is a common historical trend in U.S. family law. The burden of proof for separate property almost always falls on the person claiming it. If you cannot produce the paper trail, the law frequently defaults to a 50-50 split in community property states or a fair distribution in equitable distribution states. Now, imagine the complexity when you introduce 401k loans into this scenario. In 2026, data shows that a significant percentage of American workers have utilized the loan feature of their 401k to pay for home down payments or high-interest debt. Let's say a couple, David and Jennifer, took out a $40,000 loan from David's 401k to remodel their kitchen 2 years before their divorce. At the time of filing, $20,000 of that loan is still outstanding. The plan administrator views that $20,000 as an asset because it is money that will eventually be paid back into the account. However, if David is the one who has to pay it back through payroll deductions, but Jennifer is awarded half of the gross account balance, David is effectively paying back a loan for a kitchen he no longer lives in, while Jennifer receives a windfall based on an inflated account value. Step by step, the division of a 401k with an outstanding loan requires a specific calculation. First, you must determine if the loan was used for a marital purpose. If David took the loan to pay for his own private business venture that was deemed separate property, the debt might be assigned solely to him. If it was for the kitchen, it is a marital debt. The total value of the 401k is typically calculated by taking the current balance and adding back the outstanding loan amount to reach the true marital value. Then, the split is applied to that total. If the loan isn't handled correctly in the final decree, the primary account holder might find themselves responsible for a tax hit if they leave their job before the loan is repaid, as the IRS treats an unpaid 401k loan balance upon job termination as a taxable distribution. We also have to discuss the concept of the alternate payee. In the world of QDROs, the non-employee spouse is known as the alternate payee. Their rights are surprisingly robust under federal law. For instance, an alternate payee can often elect to take their share of the 401k as a lump sum immediately, even if the employee spouse is still working and years away from retirement age. This creates a fascinating dynamic where a 45-year-old divorcee could theoretically access retirement funds to start a new life, provided they pay the income tax, while avoiding the 10% early withdrawal penalty due to a specific exception in Internal Revenue Code Section 72(t)(2)(c). This historical provision was designed to help former spouses gain financial liquidity during the transition of divorce, but it is a tool that many overlook. However, the timing of the QDRO execution is where most people fail. There is often a gap between the day the judge signs the divorce decree and the day the plan administrator approves the QDRO. During this gap, which can last months, the account participant still has control over the investments. If the participant decides to move the entire 401k into high-risk assets and the market drops 30%, the alternate payee's share might vanish before they ever receive it. Conversely, if the account is frozen by the plan administrator upon receiving a notice of adverse interest, neither party can touch the funds, even if the market is crashing. Take the case study of a tech executive in Seattle during the market volatility of the early 2020s. The divorce decree awarded the wife 50% of the husband's 401k, valued at $2 million on the day of the trial. However, it took 6 months for the attorneys to draft and finalize the QDRO. In those 6 months, the tech sector took a massive hit, and the account value dropped to $1.2 million. Because the QDRO was written to award the wife a specific dollar amount, $1 million, rather than a percentage, the husband was left with only $200,000 in his account after the transfer. If the QDRO had specified 50% of the account value as of the date of distribution, they both would have shared the loss equally, walking away with $600,000 each. This nuance in phrasing is the difference between a fair exit and financial devastation. As we look at the evolution of these cases, we see a growing trend of double-dipping disputes involving 401k contributions and alimony. In some states, a spouse might argue that the income being used to pay alimony is the same income that is being used to build the 401k, which is then divided. This creates a circular argument of asset valuation that requires a sophisticated understanding of cash flow versus balance sheet assets. But what happens when the 401k isn't the only thing on the table? What happens when one spouse has a secret 401k from a job they held a decade ago? Or when a participant tries to liquidate their account through hardship withdrawals just before filing for divorce? The methods for uncovering these hidden buckets of wealth have changed drastically with the rise of digital footprints and automated discovery tools. In the next part of this masterclass, we are moving from the mechanics of the account to the mechanics of the law. We are going to explore the terrifying world of QDRO rejections. Why do plan administrators reject over 40% of first draft orders? What are the specific trigger words that cause a 401k provider to send your legal documents back to the drawing board, costing you thousands in additional legal fees? We will also look at the impact of the Secure Act 2.0 on divorce settlements and how the changing age for required minimum distributions is rewriting the math for older couples entering gray divorce. The stakes are about to get much higher as we look at the actual paperwork that stands between you and your future. The administrative reality of the Qualified Domestic Relations Order, or QDRO, is often the most frustrating bottleneck in the entire divorce process. In 2026, even with advancements in legal technology, the rejection rate for initial QDRO drafts remains a significant hurdle for families trying to finalize their financial separation. To understand why, we have to look at the gatekeepers, the plan administrators. These are not judges or lawyers. They are corporate employees or third-party contractors hired by companies like Fidelity, Vanguard, or Charles Schwab to protect the integrity of the retirement plan. Their loyalty is not to your divorce decree. Their loyalty is to the plan documents and federal ERISA compliance. Imagine a scenario involving a woman named Elena in Chicago. Elena spent months negotiating a settlement where she would receive $250,000 from her ex-husband's 401k. The judge signed the final judgment of dissolution, and Elena's lawyer drafted a QDRO based on that judgment. However, the plan administrator rejected the order 3 weeks later. The reason? The drafting attorney used the phrase total account balance instead of the plan-specific term vested account balance. Because the husband was not 100% vested in his employer's matching contributions, the plan administrator could not legally fulfill the order. This one-word discrepancy sent Elena back to her attorney, resulting in another $1,500 in legal fees and a 2-month delay in accessing her funds. This highlights the first step-by-step technicality of Part 3, the pre-approval process. Historically, the most successful outcomes in 401k division involve sending a draft of the QDRO to the plan administrator for a preliminary review before it ever reaches the judge's desk. This step identifies potential conflicts with the plan's unique summary plan description. Every 401k plan is different. Some allow for immediate lump sum distributions to an alternate payee, while others require the alternate payee to wait until the participant reaches earliest retirement age, usually 55 or 59 and a half. If your court order mandates an immediate payout but the plan rules forbid it, that order is a useless piece of paper. Case studies from the last decade show a rising trend in what we call gray divorce, involving couples over the age of 50. For these individuals, the 401k isn't just a pot of money. It is an imminent source of survival. In 2026, the Secure Act 2.0 has fully integrated into the financial landscape, and its provisions regarding required minimum distributions, or RMDs, have changed the math for divorcing seniors. If a couple is 73 years old and divorcing, they are already required to take money out of their 401k. When that account is split via QDRO, the RMD obligations often split as well. If the alternate payee moves their portion into a new IRA, their RMD is calculated based on their own life expectancy, which might be different from their former spouse. Imagine if a 75-year-old man, Robert, is ordered to give half of his $2 million 401k to his 68-year-old ex-wife, Susan. Because Susan is younger, her RMD age under current historical trends might give her several more years of tax-deferred growth before she is forced to start taking distributions. Robert, however, must continue taking his RMDs on his remaining million. If the QDRO is not drafted to account for the current year's RMD that has already been taken or is still owed, Robert could end up paying the tax on money that Susan actually received. This is why forensic accountants now look at the tax year as a whole, rather than just the balance on the day of the divorce. We also have to discuss the dark side of 401k division, the anti-alienation provisions. ERISA was designed to prevent creditors from seizing your retirement. Ironically, a spouse is one of the few entities that can pierce that veil. However, if a participant tries to be clever by taking out a massive loan or changing their beneficiary designation, the moment they sense a divorce is coming, they often run into the concept of the automatic temporary restraining order, or ATRO. In states like California or Massachusetts, the moment a divorce petition is served, both parties are legally forbidden from changing beneficiaries or withdrawing significant funds from retirement accounts. Let's look at a case study of a high-net-worth individual in Miami who, in 2025, attempted to liquidate his 401k to buy a yacht, hoping to present the court with a depreciating asset rather than a cash-heavy retirement account. Because the ATROs were in place, the court not only ordered him to pay back the full value to his spouse, but also assigned the 10% early withdrawal penalty and the income tax liability solely to him as a sanction for waste of marital assets. Historical data shows that judges have little patience for what they call the dissipation of marital assets. If you touch the 401k after the filing date without written consent or a court order, you are essentially inviting the court to take a larger share of the remaining assets to compensate the other spouse. Step by step, the movement of funds after the QDRO is approved is also a high-risk phase. Once the plan administrator gives the green light, they will typically create a separate account for the alternate payee within the same plan, or offer a direct rollover to an external IRA. Historical trends suggest that most alternate payees choose the rollover. Why? Because staying in the ex-spouse company plan often leaves you with limited investment options, and the administrative burden of dealing with the company you no longer have a connection to. However, the rollover must be a direct trustee-to-trustee transfer. If the plan administrator sends the check to you personally, even if you intend to deposit it into an IRA, they are often required by law to withhold 20% for federal taxes immediately. While you might get that money back as a tax credit later, you will have to find other funds to make up that 20% gap when you deposit the money into your IRA to avoid it being classified as a partial distribution. The complexity further increases when we look at 401k accounts that hold company stock. This brings us to net unrealized appreciation, or NUA. If a 401k is composed heavily of the employer's stock that has grown significantly in value, there are specific tax strategies that can be utilized during a divorce to pay capital gains rates, rather than ordinary income tax rates on the growth. If the QDRO isn't written with NUA in mind, the alternate payee could inadvertently trigger a massive tax bill that could have been avoided. This is the difference between a generalist lawyer and a specialized domestic relations order expert. As we conclude this segment on the technical hurdles of paperwork, we have to look at the clock. A 401k is a living asset. Between the date of the separation and the date of the QDRO execution, the account might receive dividends, interest, or even employer matching contributions that were earned during the marriage but paid out after the separation. Who owns that growth? If your order says 50% of the balance as of June 1, 2026, and the account grows by $40,000 in interest over the following 6 months of administrative processing, you might be leaving $20,000 on the table simply because of a missing clause regarding gains and losses. In the next part of this masterclass, we are going to dive into the aggressive world of hidden assets and 401k fraud. How do people hide retirement accounts in the age of digital transparency? We will look at the red flags that suggest your spouse might have more than one 401k, and the specific subpoenas required to shake those accounts loose from former employers. We are also going to tackle the nightmare of the defunct company. What happens if you are owed a share of a 401k from a business that no longer exists? The investigation into the paper trail is about to get much deeper. The hunt for hidden retirement assets often begins with the realization that a 401k is not a single static object, but a trail of breadcrumbs left across a career spanning decades. In the United States, the average worker changes jobs approximately 12 times throughout their life. Each move represents a potential 401k account that was either rolled over, cashed out, or quite commonly forgotten. In the context of a 2026 divorce, these abandoned accounts represent a massive untapped reservoir of marital property. We see a recurring historical trend where one spouse, often the primary earner, may have several small accounts from early in their career that are disclosed during the discovery process. They might not even be doing it maliciously. They may truly have forgotten. However, from a legal and financial perspective, those funds are still marital assets if contributions were made during the marriage. Imagine a woman named Sarah in Denver who is divorcing her husband, Mark, after 25 years. Mark has a well-documented 401k with his current employer worth $400,000. But Sarah remembers that in the early 2010s, Mark worked for a startup that was eventually acquired by a larger conglomerate. Mark claims that the account was closed out, but Sarah decides to dig deeper. This is where the step-by-step process of retirement forensic discovery begins. The first tool in this deep dive is the Department of Labor's Form 5500 database. Every year, 401k plan sponsors are required to file this form, which provides a snapshot of the plan's health and its participants. By cross-referencing Mark's employment history with these filings, a forensic expert can track the movement of plan assets, even through mergers and acquisitions. The paper trail often leads to what we call the orphan 401k. When a company goes out of business or a plan is terminated, and a participant cannot be found, the funds are often moved into a default IRA or turned over to state unclaimed property divisions. However, before it reaches that stage, the money often sits in a trust account. In 2026, the search for these assets has become more digitized, but it still requires specific subpoenas. You cannot simply call a former employer and ask for a balance. You must issue a subpoena duces tecum to the former employer's Human Resources Department or the third-party administrator who managed the plan at the time of Mark's employment. If the company no longer exists, the search shifts to the Pension Benefit Guaranty Corporation or the Abandoned Plan Program under the Department of Labor. Let's look at a case study involving a defunct telecommunications company. A husband had a 401k worth $80,000 from a job he held in 2015. The company went bankrupt in 2019. During the divorce in 2026, he claimed the money was gone. However, through a diligent search of the terminal report filed during the bankruptcy, the wife's legal team discovered that the plan assets had been transferred to a successor trustee. They were able to claw back the $80,000, plus the 7 years of market growth, which had ballooned the account to over $130,000. This is why we say that no account is truly dead until you see the distribution check or the tax form 1099 are proving it was cashed out. Another layer of this retrospective involves the deliberate dissipation of assets. In the high-stakes environment of a 2026 divorce, some individuals may attempt to drain their 401k through hardship withdrawals or maximize loans just before filing. Imagine if Mark, sensing the divorce was imminent, withdrew $50,000 from his 401k under the guise of a medical hardship. Under IRS rules, a hardship withdrawal is technically allowed for specific reasons, but in a divorce court, this is often viewed as a fraudulent transfer or waste of marital assets. The court has the power to credit that $50,000 back to Mark's side of the ledger. If the total marital estate is $500,000 and Mark already spent $50,000, the judge may award Sarah $250,000 and Mark only $200,000, effectively making him pay for his own withdrawal out of his remaining share. The complexity increases when we discuss the concept of the shadow 401k, or non-qualified deferred compensation plans. These are often reserved for executives and are not governed by the same ERISA rules as a standard 401k. Because they are not qualified plans, they do not use a QDRO for division. Instead, they are divided through a process called a COAP, or court order acceptable for processing, or simply through an assignment of benefits. Historical trends show that many spouses miss these accounts entirely because they don't show up on standard benefit statements. They are essentially contractual agreements between the employer and the employee to pay out money at a later date. If you are only looking for a 401k, you might miss a multi-million-dollar deferred comp plan that is sitting right under your nose. Furthermore, we must address the rising issue of international 401k equivalents. In a globalized economy, many U.S. residents have retirement accounts in the UK, Canada, or Australia from previous international assignments. Dividing a Canadian registered retirement savings plan or a UK pension in a US divorce is an administrative nightmare that requires a specialized international QDRO equivalent. The treaty between the US and these countries dictates how these accounts are taxed, and a mistake in the drafting can lead to double taxation, where both the foreign government and the IRS take a cut of the same dollar. Step by step, the discovery phase also involves looking at the beneficiary designations. While a QDRO can change who gets the money today, it does not always automatically update the death beneficiary. There are numerous case studies where a divorce was finalized, the 401k was split, but the participant died before updating their beneficiary form. Even if the divorce decree said the ex-spouse waived all rights to the retirement, if the beneficiary form still lists the ex-spouse, the plan administrator is often legally required to pay the money to the ex-spouse under the Supreme Court precedent of Kennedy v. Plan Administrator for DuPont Savings and Investment Plan. This is the ultimate open loop in retirement law. the paperwork that survives the divorce. We are also seeing a shift in how 401k loans are treated when they are used to purchase crypto assets within a self-directed 401k. In 2026, more participants are using the brokerage link features of their 401k to invest in volatile digital assets. If a husband took a $50,000 loan to buy a digital asset that is now worth $200,000, but the loan is still being paid back into the 401k with marital wages, the characterization of that asset is a legal battlefield. Is the $200,000 gain marital property? Or is it a separate investment because it was funded by a loan? As we peel back the layers of these hidden and complex accounts, we have to look at the professionals who make this possible. The role of the QDRO specialist is distinct from the divorce attorney. A divorce attorney is a generalist. A QDRO specialist is a surgical expert who understands the Internal Revenue Code and the specific quirks of every major U.S. plan administrator. If you are relying on a standard divorce lawyer to draft the most important financial document of your life, you are playing a high-stakes game with your retirement. In the next part of this masterclass, we are going to look at the actual valuation of the 401k when things aren't as simple as a balance sheet. We will tackle the issue of market fluctuations during the divorce process, and what happens when the 401k is tied to a pension in a floor offset plan. We will also explore the psychological warfare of retirement division, and why the 401k is often used as a bargaining chip to force a spouse to give up custody or alimony. The math is getting harder, and the stakes are getting higher as we move toward the final distribution. The psychological warfare of the 401k bargaining chip is perhaps the most visceral part of the divorce retrospective. In the current year 2026, we see a recurring historical trend where the retirement account is used as a hostage in negotiations. This is especially prevalent in what we call the trade-off scenario. Imagine a woman named Linda in Ohio who has spent 20 years as a stay-at-home mother while her husband, James, built a career in corporate logistics. James has a 401k valued at $800,000. Linda's primary goal is to keep the marital home to maintain stability for their teenage children. James, knowing the emotional weight of the house, offers Linda the home and its $400,000 in equity, but only if she waives all rights to his $800,000 401k. On the surface, this might look like a fair trade to someone who isn't looking at the long-term data. However, this is where the math of the future overrides the emotions of the present. The house is a liability masquerading as an asset. It requires property taxes, insurance, maintenance, and utility payments. The 401k, conversely, is a compounding engine. If Linda takes the house and James keeps the full 401k, 10 years down the line, James's account could potentially grow significantly based on historical market trends, while Linda may have exhausted her savings just trying to keep the roof over her head. Case studies from 2024 and 2025 show that this specific trade-off is one of the leading causes of the standard of living gap between former spouses. Step by step, the valuation of the 401k in these negotiations must account for more than just the current balance. We have to look at the floor offset plan. This is a complex retirement structure where an employer provides both a defined benefit pension and a defined contribution 401k. The pension provides a specific monthly benefit, but that benefit is offset by whatever the participant receives from their 401k. In a divorce, you cannot value the 401k in a vacuum if it is part of an offset plan. If you take half of the 401k, you might be inadvertently reducing the future pension benefit for both parties, or creating a situation where the offset math becomes an administrative nightmare for the plan provider. Let's dive into the scenario of a high-stakes valuation conflict. Imagine if James's 401k isn't just in stocks and bonds, but includes a self-directed portion containing physical gold or even interest in a private equity fund. In 2026, self-directed 401ks have become more common among middle management and executive-level employees. Valuing a private equity stake is not as simple as checking a ticker symbol. It requires a formal appraisal. If James claims the private equity interest is worth $50,000, but it actually has a book value of $200,000, the entire division is skewed. Historical trends in litigation show that the spouse with less financial literacy often accepts the value provided on a standard statement, without realizing that the statement might only be updated once a year and doesn't reflect the true fair market value of the underlying assets. This brings us to the concept of the tax-adjusted present value. If we are in a courtroom in 2026, a sophisticated legal team will argue that $100,000 in a 401k is only worth $75,000 in real-world spending power once you account for the deferred tax liability. If the other spouse has $100,000 in a savings account, they have $100,000 in spending power. Dividing these two assets 50-50 is fundamentally unequal. The person receiving the 401k is receiving a future tax bill, while the person receiving the cash is receiving liquidity. We are seeing more judges allow for a tax discount to be applied to the 401k during the equitable distribution process to level the playing field. The math gets even harder when we consider the impact of market volatility during the gap period. This is the time between the date of valuation and the date of actual transfer. In a fast-moving market, an account can lose or gain 10% of its value in a single week. If the court order specifies a dollar amount rather than a percentage, the risks are entirely lopsided. Imagine if the court orders James to pay Linda $400,000 from his $800,000 account. If the market crashes the next day and the total account value drops to $500,000, James is left with only $100,000 while Linda still gets her $400,000. Conversely, if the market surges to $1.2 million, Linda still only gets $400,000, and James captures the entire $400,000 gain. This is why historical data suggests using percentage-based awards with a clause that includes gains and losses until the date of distribution. However, many 401k plan administrators refuse to calculate gains and losses on a specific portion of an account. They might say they can only transfer a flat dollar amount as of a specific date. If the plan administrator won't do the math, the burden falls back on the lawyers and the forensic accountants. This often leads to a secondary round of negotiations just to decide who gets the dividends that were paid out while the QDRO was being processed. Step by step, you must insist that your QDRO includes a provision for pro rata sharing of earnings and losses. Without this, you are effectively gambling on the market performance during the administrative delay. We also need to address the psychological pressure of the 401k loan as a weapon. In some case studies, a spouse might intentionally take a maximum loan from their 401k just before the divorce filing and use that cash for untraceable expenses or to pay off separate debts. This effectively lowers the divisible value of the account. While a forensic accountant can trace this, the cost of the investigation can sometimes exceed the value of the loan itself. This leads to a strategic stalemate where the lower-earning spouse is forced to accept a smaller settlement because they cannot afford the professional fees required to prove the dissipation of assets. As we look at the broader retrospective of 401k divorce in the USA, we see that the 401k has become the ultimate proxy for the marriage itself. It represents the labor, the sacrifice, and the shared vision of the future. When it is split, it feels like the future itself is being severed. This emotional weight often leads to irrational decision-making. People will fight over a $5,000 difference in the 401k, while spending $10,000 in legal fees to win that fight. It is a phenomenon known as the sunk cost fallacy in divorce litigation. But there is a new frontier emerging in 2026. The integration of 401k assets with Social Security equalization strategies. For couples who have been married for more than 10 years, the rules for claiming Social Security benefits based on an ex-spouse earnings record can be factored into the 401k division. If one spouse will have a much higher Social Security benefit, the court may award more of the 401k to the other spouse to ensure that both parties have a relatively equal total retirement income. This holistic view of retirement is the gold standard of modern financial planning and divorce. In the next part of this masterclass, we are going to look at the specific nightmare of the 401k and the QDRO in the context of employer bankruptcy and mergers. What happens when the company that holds your future suddenly disappears or is bought by a foreign entity? We will examine the protections offered by the PBGC and the terrifying gaps where your money might fall through the cracks. We will also dive into the specifics of 401ks for federal employees, also known as the Thrift Savings Plan or TSP, which follows an entirely different set of rules and forms. The bureaucracy is about to get much more intense. The transition from private sector 401k plans to federal retirement systems introduces a level of bureaucratic complexity that catches many high-stakes litigants off guard. In the United States, if you or your spouse work for the federal government, whether in the civil service or the uniformed services, you are dealing with the Thrift Savings Plan or TSP. While the TSP functions similarly to a 401k on the surface, the legal engine under the hood is entirely different. In 2026, the historical trend of rejecting standard private sector orders continues to be a primary source of legal delay because many attorneys still attempt to use a Qualified Domestic Relations Order, or QDRO, to divide a federal account. Under Title V of the U.S. Code, the TSP does not recognize QDROs. To touch a federal retirement account, you must use a specific instrument known as a Retirement Benefits Court Order, or RBCO. Plus 2. Imagine a scenario involving a federal law enforcement officer named David and his spouse Maria. After 15 years of marriage, they decide to divorce in 2026. David has a TSP account valued at $350,000. Their divorce decree states that Maria is entitled to 50% of the account. Maria's attorney, who primarily handles private sector divorces, drafts a standard QDRO and submits it to the TSP record keeper. 2 weeks later, the order is rejected. Why? Because the TSP requires precise, rigid terminology. For example, an RBCO must expressly refer to the thrift savings plan by name. If the order says federal 401k or government retirement account, it is discarded. Furthermore, the TSP will only accept awards stated as a specific dollar amount or a percentage of the account. If you attempt to use a complex formula, such as a pro rata share based on years of service, the TSP will not perform the math for you. They will simply return the paperwork, leaving your assets in limbo while the legal fees mount. Plus 1. Step by step, the RBCO process requires a different level of administrative caution. Once the TSP receives a draft order, they immediately place a freeze on the participant's account. In David's case, the moment Maria's attorney submits a valid-looking order, David is barred from taking new loans or making withdrawals until the issue is resolved. This can create a significant financial squeeze if the parties are relying on those funds for post-separation expenses. Historical case studies show that these freezes can last for months if the order is not drafted perfectly the first time. Moreover, the TSP has a unique way of handling the administrative costs. In 2026, the fee for processing a court order is often deducted directly from the account balance before the split is calculated. If the court order awards a flat $100,000 to Maria, and there is a $600 processing fee, that fee might come entirely out of David's remaining share unless the order specifies a different allocation. Plus 1. This brings us to the volatile world of employer instability, bankruptcy and mergers. While federal employees have the relative security of the government, private sector workers in 2026 are facing a landscape of rapid corporate consolidation. When companies merge or are acquired, 401k plans are often mapped into new systems. If you are in the middle of a divorce when your employer is acquired by a competitor, the plan administrator listed in your divorce decree may no longer exist by the time the judge signs the order. Imagine if Maria worked for a tech startup that was swallowed by a conglomerate. The old plan might be terminated, and the assets rolled into a new 401k. If the QDRO refers to the startup's plan ID, it becomes unenforceable. You then have to track down the successor trustee, which can feel like chasing a ghost through a maze of corporate filings. Historical trends show that the most dangerous scenario for a 401k participant is the distressed termination of a plan. If an employer enters Chapter 11 bankruptcy, the 401k is generally protected from creditors under ERISA, but the administrative side can crumble. While the Pension Benefit Guaranty Corporation, or PBGC, provides a safety net for defined benefit pensions, it does not insure 401k plans. If the company's HR department disappears during a bankruptcy, getting a QDRO approved becomes a nightmare of finding the court-appointed bankruptcy trustee. We have seen case studies where participants spent years trying to get their money out of a frozen 401k because the company no longer had a designated plan administrator to sign the paperwork. Now, consider the rise of alternative assets within 401ks in 2026. Following executive orders aimed at democratizing access to private equity and digital assets, many 401k plans now allow participants to hold interests in infrastructure funds or private credit. These assets are notoriously difficult to value and even harder to divide. If David's 401k holds $50,000 worth of a private real estate fund that only offers liquidity once every 5 years, how does Maria get her half? A standard QDRO cannot force a private fund to liquidate. In these cases, the historical trend is to use a set-off, where Maria takes a larger share of a more liquid asset, like the house or a different bank account, to compensate for the illiquid 401k holding. But if the 401k is the only major asset, David and Maria may be forced to remain financially tied for years, waiting for a liquidity event to occur so the plan administrator can finally cut the check. The stakes are further heightened by the 401k loan trap in federal service. Unlike most private plans, if a TSP participant has an outstanding loan, That loan is often added back into the account balance for the purpose of calculating the spouse's award. If David has a $200,000 balance and a $50,000 loan, the TSP may calculate Maria's 50% share as $125,000. If David doesn't have enough cash in the account to cover that $125,000 payment because of the loan, he might be forced to default on the loan to satisfy the court order, triggering an immediate tax liability and a potential penalty. This is a mathematical ambush that ruins the financial planning of thousands of federal employees every year. As we move forward, we must also address the Roth conversion complication that has gained momentum in 2026. With new tax laws allowing for easier in-plan Roth conversions, many participants are moving their traditional 401k funds into Roth accounts. If a spouse converts a 401k to a Roth during a divorce, they are effectively paying the tax bill with marital funds today to secure a tax-free asset for themselves tomorrow. This is a form of strategic asset positioning that requires a forensic accountant to deconstruct. The complexity of the paperwork is not just a hurdle, it is the battlefield. If you survive the TSP's bureaucracy and the corporate merger chaos, you still face the final hurdle: the actual distribution of funds. What happens if the check is lost in the mail? What happens if the receiving institution rejects the rollover because of a typo in the account number? In the next part of this masterclass, we are going to look at the tax trap of the 60-day window. We will explore the absolute catastrophe that occurs when a rollover goes wrong, and the IRS decides that your divorce settlement is actually a taxable withdrawal. We will also dive into the specifics of 72T distributions and how savvy divorcees are using specific IRS loopholes to access their retirement funds decades early without paying a dime in penalties. The strategy is about to get much more aggressive. The legal strategy surrounding the actual movement of 401k funds is where the most significant financial damage often occurs, usually due to a lack of understanding of the Internal Revenue Code. In the current year 2026, we see a recurring historical trend where divorcees inadvertently trigger massive tax bills by failing to respect the 60-day rollover window or by misunderstanding the QDRO exception to the early withdrawal penalty. To understand the stakes, you have to realize that the IRS is a silent partner in your divorce. If you don't follow their procedural roadmap, they will take their share before you ever have a chance to rebuild your life. Imagine a woman named Chloe in Seattle. At 45 years old, she was awarded $200,000 from her ex-husband's 401k. Chloe was in a hurry to secure her new housing and didn't want to wait for the administrative red tape of a direct trustee-to-trustee transfer. She requested the 401k plan administrator to send the check directly to her, intending to deposit it into her own IRA within the 60-day limit allowed by the IRS. This is the first step of a major financial trap. Because the check was made out to Chloe personally, the plan administrator was legally required to withhold 20% for federal income taxes immediately. Chloe received a check for only $160,000. Now, to complete a valid tax-free rollover, the IRS requires that you deposit the full original amount, all $200,000, into your new IRA within 60 days. Chloe only had the $160,000. To avoid taxes on the missing $40,000, she would have had to find $40,000 of her own cash to make up the difference during the deposit. Since she didn't have that extra cash, the IRS treated that $40,000 as a taxable distribution. This is a common historical case study of a failed indirect rollover that costs American divorcees millions in unnecessary taxes every year. Plus one. However, there is an aggressive strategic move that savvy divorcees use, known as the QDRO distribution exception under Internal Revenue Code Section 72T(2)(c). Most people believe they cannot touch their 401k money before age 59 and a half without paying a 10% penalty. But in the context of a divorce, the law provides a unique one-time window of opportunity. If the funds are distributed directly from the employer's 401k plan to the alternate payee as part of a QDRO, the 10% early withdrawal penalty is waived. You still owe ordinary income tax on the money, but that 10% surcharge vanishes. Plus two. Imagine if Chloe had known this. If she specifically needed $50,000 for a down payment on a new home, she could have structured her QDRO to pay $50,000 directly to her and roll the remaining $150,000 into a traditional IRA. By doing this, she would have avoided the $5,000 penalty she would have normally faced for a pre-59.5 withdrawal. This QDRO cash out is a powerful liquidity tool. But it only works if the money comes directly from the 401k plan. The moment you roll that 401k money into an IRA, you lose this protection. If you take the money out of the IRA a month later, you are back to paying that 10% penalty because IRAs do not have the same QDRO exception. Step by step, the execution of this strategy requires surgical precision. First, the QDRO must be drafted to explicitly allow for a lump sum distribution to the alternate payee. Second, the alternate payee must make the election to receive the cash before the funds are moved to an IRA. Third, the participant and the alternate payee must account for the tax withholding. If you need $50,000 net, you actually have to request roughly $65,000 to cover the automatic 20% federal withholding. This leads us to the 72T strategy for those who need long-term income but aren't yet of retirement age. While the QDRO exception is great for a one-time lump sum, what if you need a steady stream of income to pay for life after divorce? Under Section 72T, you can set up a series of substantially equal periodic payments, or SEPs. This allows you to take annual distributions from your retirement account based on your life expectancy without paying the 10% penalty. Historical trends show that this is an essential strategy for younger divorcees who walked away with a significant 401k but no immediate career prospects. Plus one. The danger of 72T payments, however, is their rigidity. Once you start these payments, you must continue them for 5 years or until you reach age 59 and a half, whichever is longer. If you miss a payment or change the amount even by $1, the IRS can retroactively hit you with the 10% penalty on every dollar you've taken out so far, plus interest. It is a financial all-in move that requires a dedicated tax professional to manage. Plus one. As we look at the broader retrospective of 2026, we are also seeing the rise of the Roth conversion divorce. Because many people are in a lower tax bracket in the year their divorce is finalized, due to the loss of a second income or the high costs of legal fees, it can be a strategically advantageous time to convert a portion of the 401k they received into a Roth IRA. While you pay the taxes now, you are essentially buying a future where your growth and withdrawals are tax-free. If you receive $500,000 in a 401k division, and you expect your income to rise significantly in the coming years, paying the tax at your current divorce-depressed rate could be a masterstroke of long-term wealth preservation. But what happens when the 401k is tied to employer stock that has net unrealized appreciation, or NUA? This is one of the most technical corners of the tax code. If the 401k holds stock in the employer's company that has grown significantly, the alternate payee can move the stock into a brokerage account rather than an IRA. They would pay ordinary income tax only on the original cost of the stock, while the entire growth, the appreciation, would be taxed at the much lower long-term capital gains rate. If you roll that company stock into an IRA instead, you lose the NUA tax advantage forever, and every penny of that growth will eventually be taxed at higher ordinary income rates. The math of 401k divorce is not just about who gets what. It is about which tax bucket you use to hold your future. If you choose the wrong bucket, you are effectively giving the government a 10 to 20% tip on your divorce settlement. In the next part of this masterclass, we are going to look at the death of the participant. What happens if your ex-spouse dies after the divorce is finalized but before the QDRO is processed? We will explore the terrifying marble versus marble style scenarios where the new spouse and the ex-spouse end up in a multi-year federal lawsuit over the same 401k. We will also look at the role of survivor benefits and why you might be entitled to a portion of your ex-spouse's retirement, even if they marry someone else. The stakes are moving from life to death as we enter the home stretch. The intersection of mortality and the qualified domestic relations order is perhaps the most precarious phase of a 401k retrospective. In the United States, a terrifying administrative gap exists between the moment a judge signs your divorce decree and the moment the plan administrator officially segregates the funds. This is known as the purgatory period. If the account participant dies during this interval without a preliminary or joinder order in place, the consequences for the surviving ex-spouse can be catastrophic. Historically, under the Employee Retirement Income Security Act, the plan administrator is generally bound by the beneficiary designation on file at the time of death. If that designation has not been updated or overridden by a specific, federally compliant court order that has already been served, the 401k funds might be paid out to a secondary beneficiary, perhaps a sibling, a parent, or a new spouse, leaving the ex-spouse with a legal claim that is nearly impossible to enforce against a disbursed account. Imagine a scenario involving a man named Thomas in Pennsylvania in 2026. Thomas and his wife Sarah finalized their divorce in January. The decree awarded Sarah $300,000 from Thomas's 401k. However, the attorneys were slow to draft the formal QDRO. In March, before the QDRO was submitted to the plan administrator, Thomas passed away unexpectedly in an accident. Because the plan administrator had not received a court-approved QDRO, they looked at Thomas's beneficiary form, which he had updated 3 weeks prior to list his new girlfriend as the 100% beneficiary. Despite the divorce decree being a legal judgment, the 401k plan, governed by federal ERISA law, paid the entire $300,000 to the girlfriend. This is a real-world application of the Supreme Court precedent set in Kennedy v. Plan Administrator for DuPont Savings and Investment Plan. The court essentially ruled that the plan documents control the distribution, not the external divorce decree. To prevent this outcome, the step-by-step technical process requires the use of a nunc pro tunc order, or a preliminary QDRO. A nunc pro tunc order is a Latin term meaning now for then. It is a retrospective legal correction that asks the court to treat the QDRO as if it had been entered on the date of the divorce decree, effectively jumping ahead of the participant's death in the eyes of the law. However, not all plan administrators accept these. A more robust strategy involves filing a joinder or a notice of adverse interest immediately upon the filing of the divorce petition. This puts the plan administrator on notice that a second party has a claim to the funds, effectively freezing the ability to change beneficiaries or make withdrawals while the litigation is pending. Furthermore, we must address the concept of survivor benefits within the 401k structure. While survivor benefits are more commonly associated with traditional pensions, many 401k plans have specific provisions for a qualified pre-retirement survivor annuity, or QPSA. If the participant dies before retiring, the surviving spouse is often entitled to a portion of the account. In a divorce, a well-drafted QDRO should specify that the alternate payee is to be treated as the surviving spouse for the purposes of these benefits. If this language is missing, and the participant remarries and then dies, the new spouse will typically receive the survivor benefits, regardless of what the divorce decree intended. Historical trends in 2025 and 2026 show an increase in litigation between first and second spouses precisely because of this missing sentence in the QDRO. Consider the case study of a federal employee who had a substantial thrift savings plan balance. The first wife was awarded 50% of the account in 1995. The husband remarried and worked another 20 years, retiring in 2015. When he died in early 2026, the TSP system had to determine who the legal survivor was. Because the first wife's order did not explicitly designate her as the surviving spouse for the death benefits portion of the plan, the second wife received the entire remaining balance plus the survivor annuity. The first wife was left with only the contribution she had received decades earlier, missing out on the significant death benefit protections that would have secured her own late-stage retirement. This brings us to the separate interest versus shared interest distinction. In a separate interest QDRO, the alternate payee's portion of the 401k is carved out and put into a separate account. This is the gold standard for protection because once the account is in your name, the ex-spouse's death has zero impact on your money. You own the account, you control the investments, and you name your own beneficiaries. However, some older 401k plans or specific types of retirement vehicles only allow for a shared interest. This means you only receive a portion of the payments as they are made to the participant. If the participant dies in a shared interest scenario and you do not have survivor benefit protections, your checks stop the moment they stop breathing. Step by step, you must analyze the plan summary description to see if a separate interest is even an option. If it is, you should almost always take it. It decouples your financial future from the life expectancy of your former spouse. If you are forced into a shared interest model, you must ensure that the QDRO includes a provision for a survivor annuity. Without it, you are effectively taking a gamble on your ex-spouse's health. The stakes are even higher when we look at the 2026 landscape of gray divorce and the impact of the Secure Act 2.0. If a participant dies and the alternate payee is much younger, the rules for how quickly that money must be withdrawn and taxed have changed. The 10-year rule for non-spouse beneficiaries generally requires the account to be emptied within a decade. However, an alternate payee under a QDRO is typically treated with the same tax deferral privileges as a spouse, meaning they can potentially stretch those distributions over their own life expectancy. If the plan administrator misclassifies the transfer as a standard inheritance rather than a QDRO transfer, the tax consequences can be accelerated by decades. Imagine the psychological toll of this process. You are navigating the end of a marriage while simultaneously preparing for the potential death of your former partner, all while fighting a corporate bureaucracy that views you as a data point. The historical data from the last 5 years indicates that over 15% of QDRO-related assets are lost or tied up in probate because of a failure to address the death of a party during the transition period. We are also seeing a rise in post-judgment discovery cases. This is where an ex-spouse dies, and during the probate process, it is discovered that they had a secret 401k that was never disclosed during the divorce. In 2026, many states allow for the reopening of a divorce settlement if fraud or non-disclosure is proven, even if the participant is deceased. The surviving spouse can then file a claim against the estate to recover their share of the hidden retirement funds. As we conclude this deep dive into the mortality of the 401k, we have to recognize that the paperwork you sign today is not just for your life together. It is for the protection of your future, regardless of who survives whom. The technicality of a single paragraph can be the difference between a dignified retirement and a multi-year legal battle against a grieving estate. In the next part of this masterclass, we are going to look at the clawback and correction phase. What happens when the plan administrator makes a mistake and gives you too much money? We will explore the aggressive tactics companies use to get that money back, including freezing your other bank accounts. We will also look at the role of malpractice in retirement division and how to hold your own legal team accountable if they miss these critical deadlines. The investigation into the errors of the system is just beginning. The administrative machinery behind a 401k is not infallible, and in 2026, we are seeing a significant rise in recoupment actions that turn retirement dreams into legal nightmares. This is the phase of the retrospective where we look at what happens when the system fails itself. In the United States, plan administrators are fiduciary entities, but they are also governed by strict internal auditing protocols. If a plan administrator makes a clerical error, such as miscalculating a valuation date or failing to account for an outstanding loan, and pays an alternate payee more than they were legally entitled to, the fallout is aggressive. Under federal law, plan administrators have a duty to recover overpayments to protect the tax-qualified status of the entire plan. Imagine a scenario involving a woman named Elena in Phoenix. In early 2025, she received a distribution of $450,000 from her ex-husband's 401k following a finalized QDRO. She immediately rolled those funds into a new IRA and used a portion to pay off her mortgage. 14 months later, in 2026, she received a letter from the former plan administrator stating that a software glitch had failed to account for a market drop that occurred during the processing period. The letter claimed she was actually only entitled to $415,000 and demanded the immediate return of $35,000. This is what is known as a plan overpayment recoupment. Because the funds were already moved to an IRA, the administrator may threaten to sue Elena or, more commonly, report the overage to the IRS as an unqualified distribution, which would trigger immediate taxes and penalties for her. Historical trends show that these errors are more common during periods of high market volatility or corporate restructuring. Step by step, if you receive a demand for recoupment, the first thing a forensic expert will do is audit the plan's own math. Often, the plan administrator's correction is also based on flawed data. However, if the error is legitimate, the Secure Act 2.0 has provided some limited protections for participants. In many cases, if the overpayment was a result of a plan error and the participant did not knowingly contribute to the mistake, the plan might be restricted from charging interest or may have to limit the recovery period. But for most, the initial instinct of the plan is to simply take the money back by any means necessary, including withholding future benefits or even garnishing other accounts within the same financial institution. This brings us to the high-stakes world of legal malpractice in retirement division. Dividing a 401k is a technical specialty that sits at the intersection of family law, tax law, and ERISA law. Many general practice divorce attorneys treat the QDRO as a secondary task, often outsourcing it to a third-party preparer without a thorough review. If an attorney misses a filing deadline, fails to include a clause for market gains and losses, or incorrectly identifies the plan name, the financial damage can be permanent. In 2026, we are seeing a spike in professional liability claims against divorce firms specifically for retirement asset errors. Consider the case study of a client named Marcus. His attorney drafted a QDRO that awarded his ex-wife 50% of the account as of the date of filing. However, the attorney failed to submit the order to the court for signature for 9 months. During those 9 months, the 401k balance grew from $1 million to $1.3 million due to a massive market rally. Because the order specified the date of filing, the wife received $500,000, and Marcus kept $800,000. The wife sued her own attorney for the $150,000 in growth she lost due to the filing delay. Historical trends in these malpractice cases suggest that the primary defense used by attorneys is the complexity of the plan administrator's requirements, but courts are increasingly holding legal teams to a standard of administrative diligence. To avoid these pitfalls, a step-by-step deep dive into your legal representations process is required. You must ask, who is drafting the QDRO? Is it a specialized QDRO counsel? Has the draft been pre-approved by the plan administrator? Does the order include a backup provision for the death of either party? If your attorney cannot answer these questions with specificity, the potential outcomes for your portfolio are at risk. Another emerging error in 2026 involves the double reporting of tax liability. When a 401k is split, the plan administrator must issue 2 separate 1099-R forms, one to the participant and one to the alternate payee. If the administrator's system fails to update the tax ID associated with the distribution, the original account holder might be billed for the taxes on the entire withdrawal, even the half they didn't receive. Correcting this with the IRS after the fact is a bureaucratic odyssey that can take years to resolve, often requiring the filing of Form 8082 to report inconsistent treatment of an item. Imagine the complexity if the plan administrator itself goes into receivership or is replaced by a new firm. We have seen case studies where a QDRO was approved by Firm A, but the check was never cut. By the time the follow-up occurred, Firm B had taken over the records and claimed they had no record of the approved order. This creates a lost in translation scenario where the assets are essentially trapped in an accounting void. The only solution is to maintain a perfect paper trail of every communication, every time-stamped approval, and every confirmation number provided by the plan's customer service representatives. We must also address the missing participant error from the perspective of the plan itself. In 2026, if a plan administrator cannot find a former spouse to pay out their share of a QDRO, they may move those funds into an unclaimed property account or a default IRA. Once the money moves to the state's unclaimed property division, it stops growing. It sits in a zero-interest or low-interest account, losing value against inflation every single day. Historical data suggests that hundreds of millions of dollars in 401k divorce settlements are currently sitting in state treasuries because the alternate payee moved and never updated their address with the plan. Step by step, if you are the one waiting for a distribution, you must be the primary driver of the communication. You cannot assume your attorney is checking in on the status. You must verify that the plan administrator has your current address, your correct social security number, and a direct deposit form on file. The system is designed to process, not to hunt you down to give you money. As we conclude this examination of systemic errors and professional liability, we must look at the psychological weight of this administrative combat. Many people give up because the process is too exhausting. They accept a lower settlement or ignore an error because they simply want the divorce to be over. But in the context of a 401k, a $10,000 error today can be a $100,000 loss in retirement purchasing power 30 years from now. In the final part of this masterclass, we are going to wrap up the entire retrospective by looking at the future-proofing of your retirement. We will explore the emerging trends of 2026 and beyond, including the integration of AI in QDRO drafting and the potential for blockchain-based retirement tracking. We will also give you the final checklist to ensure that when the dust settles, your 401k isn't just a number on a page, but a secured foundation for your new life. The masterclass is reaching its conclusion, and the final moves are the most important. The final moves in this deep dive retrospective focus on the concept of financial closure and the technological evolution that is redefining how we track assets in the year 2026. As we move into the final stage of 401k division, we must address the emergence of digital asset tracking and the integration of artificial intelligence in domestic relations law. Historically, the burden of discovering every retirement account rested on manual discovery, lawyers exchanging boxes of paper and forensic accountants squinting at blurred bank statements. Today, we see a shift toward automated asset discovery tools that scan historical tax filings and employment records to flag accounts that may have been forgotten or deliberately omitted. Imagine a man named Christopher in San Francisco who is finalizing his divorce after a career in the high-stakes tech industry. Christopher had worked for 6 different companies over 15 years, each with its own 401k provider. His spouse, Natalie, suspected there were more assets than what was listed on the standard disclosure form. By utilizing a 2026-era automated forensic tool, her legal team was able to identify 3 dormant 401k accounts from Christopher's early career that had been rolled over into a master trust during a series of corporate acquisitions. These accounts, which Christopher had genuinely forgotten about, had grown through passive market appreciation to a combined value of $180,000. This case study highlights a critical step in the modern divorce process: the transition from trust-based disclosure to data-verified transparency. Step by step, the finalization of a 401k division requires a post-distribution audit. Once the funds have reached the alternate payee's account, the process is not truly over until a reconciliation is performed. This involves comparing the final amount received against the language of the QDRO. If the order specified a percentage of the account as of a specific date plus earnings and losses, you must verify that the plan administrator actually calculated those earnings correctly. Historical trends suggest that plan administrators often use simplified interest rates or default to the most recent month-end valuation, which can lead to discrepancies of several $1,000s. If a discrepancy is found, your legal team must immediately file a motion for clarification or a request for administrative correction before the plan account is fully closed and the record is archived. Furthermore, we must discuss the importance of the clean break principle. In the landscape of 2026, the goal of any high net worth 401k division is to reach a state of total financial independence. This means ensuring that no residual links remain between you and your former spouse's retirement plan. If you are left as a participant in your ex-spouse's plan, meaning they kept the 401k but gave you a monthly benefit to be paid out later, you are still tethered to their employer's administrative health. If the company goes bankrupt or the plan is terminated 20 years from now, you will be forced to engage in a legal battle alongside your ex-spouse to recover your share. Whenever potential outcomes allow, the preferred strategy is to take a lump sum rollover into your own IRA. This places the control of the asset entirely in your hands, allowing you to choose your own investment strategy and beneficiary designations without interference. This leads us to the critical checklist for the final 30 days of the 401k division process. Step 1. Verify that the new account is titled correctly. If you are rolling funds into an IRA, the account must be in your name only. Step 2. Establish a new beneficiary designation immediately. Many people assume the QDRO or the divorce decree automatically protects their heirs, but as we've discussed in previous parts, the beneficiary form at the financial institution is usually the final authority. Step 3. Ensure that the tax basis of the transferred funds is recorded correctly. If you received Roth 401k funds, you must ensure your new custodian recognizes them as such so you aren't taxed again on the back end. We also see a rising trend in the use of blockchain-based verification for retirement records. In 2026, some of the largest plan administrators have begun utilizing distributed ledger technology to create immutable records of account contributions and valuations. This reduces the risk of the missing participant error and makes the tracing of premarital versus marital assets significantly more accurate. For those entering a divorce today, checking if your plan administrator uses these advanced record-keeping systems can save dozens of hours of forensic accounting time. Imagine the scenario of a woman named Samantha, who is divorcing an estate that follows equitable distribution. Her husband's 401k was exceptionally complex, involving multiple tiers of vesting and employer matching schedules. In the past, calculating the marital portion of such an account would have required a month of manual math. Today, the transparency of digital record-keeping allows for a real-time calculation of the coverture fraction, providing both parties with a clear, undisputed number. This level of clarity reduces the emotional friction of the divorce and allows for a faster path to resolution. As we look at the historical trajectory of 401k divorce in the United States, it is clear that the retirement account has evolved from a simple savings bucket into a highly regulated, mathematically complex asset that requires specialized management. The data from the last decade shows that those who approach the 401k with the same level of scrutiny as they would a business merger or a large real estate transaction are the ones who thrive in the years following their divorce. The 401k is not just a part of the past, it is the primary engine of your future stability. This concludes our 10-part deep dive masterclass on the retrospective of 401k divorce in the USA. We have covered everything from the initial viral hook of the 50% loss to the intricate tax traps of 72T distributions, the bureaucratic hurdles of the TSP, the nightmare of plan overpayments, and the administrative purgatory of the death of a participant. You now have the historical context and the technical roadmap to understand how the system operates at its most granular level. However, as one chapter closes, another begins. The division of the 401k is only half of the retirement story in a modern U.S. divorce. While the 401k represents the individual account, many Americans also have a hidden claim to a much larger, often misunderstood pool of wealth that requires an entirely different set of rules to unlock. This asset doesn't appear on a 401k statement, but it can be worth hundreds of thousands of dollars over a lifetime. Next, we are pivoting our investigation into the most controversial and underutilized asset in the American family law system: the Social Security spousal benefit and the pension offset. We will explore how a marriage lasting exactly 10 years and 1 day can be the difference between a poverty-level retirement and a six-figure lifetime windfall. We will dive into the strategies for timing your filing to maximize the claim on an ex-spouse's earnings record without ever reducing their own check. The game of retirement division is about to get much more strategic as we move into the realm of federal entitlements and social insurance. Stay tuned for our next deep dive series, where we uncover the secrets of the 10-year rule and the Social Security divorce loophole.